All right, Sarat, so lay the groundwork for us. Why does the thesis make sense to you right now that value is just better than growth in this market?
So I think given the uncertainty of where interest rates are going to be, cash flow is really important. And I think investors are going to look at companies, especially when you look at discount rates. And if rates are going to go up, you want more certainty. We've had so much volatility over the last 6 months to a year. If you can find companies that are undervalued, have good cash flow, growing solid balance sheets, and a growing dividend, I think at least for the next couple of years, if you get anything from a 5 to 7% earnings growth with 3 to 5% dividend yields, you're looking at 10%, and 10% in this market's pretty good.
What would you consider good cash flow right now?
So let me give you an example. A company called Steelcase. Steelcase. So you might look at it and go, "Hey, wait a second. Why do we want to be in an area that has office furniture?" But you're looking at a company that is pre-pandemic levels, inflationary pressure, and you've got now demand improving. So people are remodeling their offices, not just to come back, but also for the new kind of hybrid. So demand is there. Steelcase is now raising prices. Inflationary pressure is coming off. The stock trades at 9 times earnings, has a 5.5% dividend yield with a very solid balance sheet, and they expect earnings to grow anywhere from 8 to 10%. So if you have that for the next 3 to 5 years, you're looking at a higher than 12% return with a company that has some of the wind at its back.
That is an interesting one. I have to admit, I was a little surprised when you suggested a company that makes office furniture with all the discussion of potentially hybrid being more permanent. What about Edison International, a utility stock, really?
Yeah, so if utilities have done really well, but Edison's kind of lagged. They're 15 times earnings, and they're a distribution and transmission company, so they're not in the generation part. So they actually have the ability, because of regulatory reasons, to control kind of what their earnings are. So if you look at kind of what their earnings expectations, which are anywhere from 6 to 7%, and you have a close to a 4% dividend yield, that's a pretty good return in a market that again, is not giving investors too much. But what I like about Edison is that it's been over almost 4 years since they've had a fire there, and investors are still penalizing a company like Edison for that because they were actually responsible for that. So they really cleaned up their act. They're working with California. They're much more green than they were before. And I think, here's a company that is in a really good space.
So I want to go back to Steelcase for just a second, because it's funny, office furniture. We got Ethan Allen coming up in just a couple minutes. Furniture all over the place seems to be doing well, but how durable is that? Is that just perhaps an aftershock of the pandemic where some people are going back to the office and you need some new furniture, but not over a long period of time?
So, what we're looking at is the remodeling. It's companies coming back, and, we're doing it. We talk to other clients who are doing it. They're saying, look, the office of the past is going to be different from the office of the future. So what do we need to do that? Do we need to have more places where people can have Zoom calls? Can we have more places where people can do hoteling? All that requires different type of furniture, and that furniture, not just in the office, but you're going to have it in the home office too. Because now, as people say, I'm going to spend 1, 2, whatever days it is in my home, my second home, all that is going to be demand that wasn't there before, and it's incremental new demand that's going to be recurring in nature.
Okay. Yeah, I can see that. Sarat, Sethi, thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.